What if the biggest investing mistake most people make has nothing to do with timing the market, picking the wrong stocks, or even panic selling during crashes, but instead comes from how they think about technology itself? Over the last 10 years, the S&P 500 has delivered strong returns. But during that same period, certain technology-focused strategies didn't just outperform. It wasn't even close. While the broader market rose roughly 200%, some technology approaches compounded more than 3 times that amount. That gap isn't noise, it isn't luck, and it isn't something that only happened once. It's the result of a structural shift in how the global economy works. Most investors believe they're invested in technology because they own the S&P 500, or a growth ETF, or a popular tech index. But what if those products are quietly built in a way that systematically overweights the most expensive companies, underweights the most efficient ones, and ignores the single factor that has driven the greatest wealth creation of the last 4 decades? Low marginal cost. This is the hidden force behind many of the world's most dominant companies. It's the reason software-driven businesses scale faster, become more profitable over time, and consistently outperform traditional industries. And yet, most portfolios treat these companies the same way they treat businesses that still rely on physical inputs, rising labor costs, and linear growth models. Even more surprising, many of the most powerful software companies in the world aren't even classified as software. Some of them are labeled as financial services, others as consumer technology, others as internet or communication companies. But underneath the surface, they all share the same economic engine. Software platforms that automate processes, reduce costs, eliminate friction, and scale globally at near zero incremental expense. And that raises a critical question. If technology has outperformed every other sector by such a massive margin, if software platforms continue to replace labor, automate industries, and increase productivity, and if profitability and valuation still matter more than hype or speculation, then why do so many technology portfolios remain volatile, inefficient, and filled with unprofitable companies? The answer lies in how most indexes are built. Market cap weighting rewards companies after they've become expensive. Speculation is often mistaken for innovation, and diversification is sometimes taken so far that it actually lowers returns while increasing risk. But what if technology investing could be done differently? What if you could isolate only the most profitable software platforms, remove companies that burn cash and rely on promises instead of earnings, weight businesses by fundamentals instead of hype, and systematically rebalance the portfolio so that valuation discipline is never ignored? That's exactly what this video is about. In this deep dive, we're breaking down a software platform investment framework designed to capture the long-term power of technology while actively reducing the risks that most investors fear. We'll explore why low marginal cost matters more than sector labels, how profitability screens change the entire risk profile of tech investing, and why concentration, when done correctly, has historically produced better outcomes than over-diversification. This isn't about chasing trends. It's not about guessing which company will be next. And it's not about short-term market moves. It's about understanding the economic mechanics that have already created some of the most valuable companies in history and positioning a portfolio to benefit from the same forces going forward. If you've ever wondered why technology keeps winning, why some investors consistently outperform while others lag behind, or whether it's possible to invest in tech with confidence instead of fear, then this is a video you'll want to watch all the way through. Over the past several decades, financial markets have undergone a fundamental transformation. While traditional industries once dominated economic growth, technology-driven companies have steadily taken center stage. This shift is reflected clearly in long-term market performance. Over the last 10 years, broad market indexes such as the S&P 500 have delivered solid gains, rising approximately 200%. During the same period, technology-focused strategies have produced dramatically higher returns, in some cases exceeding 600%. This difference is not the result of short-term speculation or isolated success stories. Instead, it reflects deep structural changes in how modern businesses operate, scale, and generate value. Investors who understand these changes and who position their portfolios accordingly have historically been rewarded with significantly higher long-term returns. At the core of this discussion is the rise of software-driven business models and the growing dominance of companies with low marginal costs, high scalability, and strong profitability. Understanding why these characteristics matter and how they can be systematically captured through disciplined portfolio construction is essential for investors looking to build long-term wealth. Technology's structural advantage over traditional sectors. Technology has outperformed nearly every other sector over extended time horizons. When comparing sector-level performance over 10, 15, or even 20 years, technology consistently stands apart. While some sectors struggle to grow at all over long periods, technology has compounded at rates that are multiples higher. This outperformance is rooted in the economics of software and automation. Unlike traditional industries, such as manufacturing, energy, or materials, software businesses are not constrained by physical inputs. They do not require proportional increases in labor, raw materials, or logistics as they grow. Instead, once the initial product is built, distribution can occur at minimal additional cost. As a result, technology companies often experience expanding profit margins as revenue increases. This creates a compounding effect where earnings grow faster than sales, driving long-term shareholder value. Importantly, these advantages are not cyclical or temporary. The global economy continues to digitize, automate, and rely more heavily on software platforms. From payments and logistics to communication and data storage, software has become the backbone of modern commerce. The importance of low marginal cost businesses. One of the most important concepts underpinning this investment approach is low marginal cost. Marginal cost refers to the cost associated with producing one additional unit of a good or service. In traditional industries, marginal costs are often high. Each new car, appliance, or chemical product requires significant additional resources. In contrast, many software products can be delivered to additional users at little to no incremental cost. Once developed, a piece of software can be distributed globally with minimal expense. This creates exceptionally high operating leverage. Low marginal cost businesses tend to share several key characteristics. They scale efficiently. They require less capital to grow. They are less reliant on debt. They generate strong free cash flow. They achieve high returns on invested capital. These traits not only drive higher returns, but also reduce financial risk. Companies that do not need to borrow heavily to expand are generally more resilient during economic downturns. Moving beyond traditional sector. Definitions. One of the limitations of traditional investment frameworks is how narrowly they define sectors. Many indexes classify companies strictly based on outdated industry labels, failing to capture how businesses actually create value today. For example, certain companies categorized as financial services or consumer businesses are, in reality, software platforms. Payment networks, digital marketplaces, and online service providers rely primarily on proprietary software to operate and scale. A broader definition of software platforms allows investors to identify companies that automate complex processes, reduce friction and errors, save time and labor, operate across global networks, deliver digital infrastructure at scale. This cross-sector approach improves diversification while maintaining exposure to the most scalable and profitable business models. From active management to index-based discipline, the initial implementation of this investment philosophy took the form of an actively managed growth strategy focused on high-growth, profitable companies with low marginal costs. Over multiple calendar years, this approach delivered substantial outperformance relative to major benchmarks such as the Nasdaq 100 and the S&P 500. However, high-growth strategies are often accompanied by higher short-term volatility. While long-term returns may be superior, investors can experience larger drawdowns during periods of market stress. Recognizing that not all investors are comfortable with this volatility, a complementary strategy was developed in the form of a rules-based software platform index. The goal was to retain exposure to technology's structural advantages while emphasizing valuation discipline, profitability, and lower volatility. Why market cap weighting creates inefficiencies? Most traditional indexes weight holdings by market capitalization. While simple and transparent, this approach has a critical flaw. It increases exposure to companies as they become more expensive. As stock prices rise, their weight in the index increases, even if valuation metrics become stretched. This can lead investors to systematically overallocate capital to overvalued companies while underweighting attractively priced opportunities. A valuation-aware weighting system addresses this issue by incorporating additional factors beyond size. By considering profitability, earnings multiples, and capital efficiency, the index can allocate capital more rationally. This approach mirrors how an informed investor might evaluate individual stocks, seeking strong businesses at reasonable prices rather than blindly following price momentum. The role of profitability screens. A defining feature of the software platform index is its exclusion of unprofitable companies. While some unprofitable firms eventually succeed, many do not. Speculative business models introduce significant downside risk and often rely on continued access to external capital. By focusing exclusively on companies that already generate earnings, the strategy aims to reduce the likelihood of large permanent losses, avoid reliance on speculative future outcomes, improve consistency of returns, lower overall portfolio volatility. Historical analysis suggests that portfolios emphasizing profitable growth companies can achieve competitive or superior returns compared to portfolios that include speculative names, often with less risk. Multi-factor weighting for quality and stability. The index applies a structured, rules-based weighting methodology that incorporates several key factors. 1. Marginal cost efficiency companies with lower cost relative to revenue are favored. 2. Valuation metrics. Lower price-to-earnings ratios receive higher weights. 3. Profitability. Only companies with positive earnings are eligible. 4. Return on invested capital. Businesses that generate strong returns from reinvested capital are prioritized. This multi-factor approach seeks to balance growth with valuation and quality, resulting in a portfolio designed to deliver long-term returns with reduced volatility relative to traditional technology indexes. Portfolio concentration and diversification. The portfolio typically holds around 50 companies, with a significant portion of assets allocated to the top holdings. This level of concentration is intentional and grounded in historical evidence. Data consistently shows that large-cap companies outperform small-cap stocks over long periods. A relatively small number of stocks drive most market returns. Excessive diversification into lower-quality assets can dilute performance. Rather than diversifying for its own sake, this strategy concentrates capital in companies with proven scalability, profitability, and durability. Diversification is achieved not by increasing the number of holdings indiscriminately, but by ensuring exposure across multiple software-driven industries and use cases. The role of rebalancing. The index is rebalanced quarterly. Rebalancing serves several important functions: removing companies that no longer meet profitability criteria, adjusting weights as valuations and fundamentals change, reallocating capital toward stronger opportunities. This process ensures that the portfolio remains aligned with its underlying principles. It also removes emotion from decision-making, relying instead on systematic rules. If a company becomes unprofitable or excessively overvalued, its weight is reduced or eliminated. If another company improves its fundamentals, it may receive a higher allocation. Understanding performance and compounding. Back-tested performance of the software platform index shows substantial outperformance relative to major benchmarks over long periods. Over a 10-year horizon, cumulative returns significantly exceeded those of the S&P 500. While back-tested results do not guarantee future outcomes, they illustrate how disciplined exposure to profitable, scalable technology businesses has historically compounded at higher rates. The power of compounding becomes especially evident over multiple decades. Outperformance of several hundred percentage points over one decade can lead to dramatically larger portfolios when sustained over longer horizons. Expense ratios and long-term value. The index ETF carries a higher expense ratio than basic market cap weighted funds, but remains competitive relative to specialized sector ETFs. The additional cost reflects proprietary index construction, factor-based weighting methodology, ongoing research and maintenance. Importantly, investors experience returns after fees. Historical evidence suggests that disciplined, factor-based strategies can more than offset modestly higher costs through improved long-term performance. Dividends, buybacks, and capital allocation technology companies typically pay low dividends, preferring to reinvest capital into growth initiatives or share buybacks. Buybacks reduce share count, increase ownership concentration, and often provide tax-efficient returns for investors. For investors seeking income, selling a small portion of shares can replicate a dividend while potentially incurring lower taxes. This approach prioritizes total return rather than income generation, aligning with the long-term growth focus of the strategy. Addressing volatility and risk perception technology is often perceived as volatile, but much of that volatility stems from speculative, unprofitable, or overvalued companies. By excluding these elements, the strategy aims to maintain exposure to technology's upside while reducing unnecessary risk. Volatility is not eliminated, but it is more closely tied to fundamental business performance rather than hype or speculation. Common investor pitfalls. Several common mistakes this framework seeks to avoid include overpaying for growth, investing in unprofitable companies based on promises, excessive diversification into low-return assets, relying on option-based income strategies that cap upside. Long-term equity returns are driven by business growth and profitability, not financial engineering. Concentrating on high-quality, scalable companies has historically produced superior outcomes. Looking ahead. Technology's ongoing evolution. Looking forward, advances in automation and artificial intelligence are expected to further enhance productivity and profitability across industries. Many companies are already increasing earnings without increasing expenses, a powerful dynamic for shareholders. As innovation accelerates and scalability improves, software platform companies are positioned to capture an even larger share of global economic value. The long-term thesis remains consistent. Software reduces costs. Automation increases efficiency. Profitable scalability compounds returns. For investors focused on long-term wealth creation, disciplined exposure to high-quality software platforms represents a compelling and enduring strategy. This video examined the long-term forces that have driven technology to outperform nearly every other sector of the market and explained why software-driven platform companies sit at the center of that performance. Over multiple decades, technology has delivered superior returns not because of short-term innovation cycles or market speculation, but because of fundamental economic advantages embedded in software-based business models. At the core of this advantage is low marginal cost. Once software is developed, distributing it to additional users requires minimal incremental expense. This allows revenue to grow faster than costs, leading to expanding margins, strong free cash flow, and long-term compounding. Companies built on this model are able to scale globally without the constraints faced by traditional industries that rely on physical inputs, labor expansion, or complex logistics. The video also challenged conventional sector classifications, showing that many of the most powerful software platforms are not labeled as software companies at all. Instead, they operate across industries such as financial services, consumer technology, and internet services, while relying fundamentally on software to automate processes, reduce friction, and increase efficiency. By identifying companies based on how they generate value rather than how they are categorized, investors gain access to a broader and more accurate opportunity set. Another key focus was the limitation of traditional market cap-weighted indexes. While simple, market cap weighting systematically increases exposure to companies as they become more expensive, often leading to overconcentration in overvalued stocks. In contrast, a valuation-aware, rules-based approach incorporates profitability, earnings multiples, and return on invested capital to allocate capital more efficiently. The software platform investment framework discussed in this video excludes unprofitable companies entirely. While some unprofitable firms eventually succeed, many rely on speculative growth assumptions and continued access to external capital. By focusing only on companies that already generate earnings, the strategy aims to reduce downside risk, improve return consistency, and lower overall volatility without sacrificing long-term growth potential. Portfolio construction plays a central role in this approach. The strategy maintains a concentrated portfolio of approximately 50 companies, intentionally allocating more capital to the highest quality businesses. Historical evidence suggests that a small number of large, profitable companies drive the majority of long-term market returns. An excessive diversification into lower-quality assets can dilute performance rather than protect it. Quarterly rebalancing ensures ongoing alignment with the strategy's core principles. Companies that no longer meet profitability or valuation criteria are reduced or removed, while those with improving fundamentals receive greater weight. This systematic process removes emotional decision-making and keeps the portfolio focused on fundamentals rather than market narratives. The video also addressed common misconceptions around technology investing, including the belief that tech is inherently unstable or overly risky. Much of that perceived risk comes from speculative, unprofitable, or overvalued companies. By excluding these elements, the framework seeks to maintain exposure to technology's upside while reducing unnecessary volatility. Finally, the discussion looked forward to the continued evolution of software, automation, and artificial intelligence. As more industries adopt software-driven solutions, companies with scalable platforms and strong profitability are positioned to capture an increasing share of global economic value. The long-term thesis remains straightforward. Businesses that reduce costs, increase productivity, and scale efficiently tend to compound value over time. In summary, this video presented a disciplined, fundamentals-driven approach to technology investing, one that prioritizes profitability, valuation, and scalability over speculation and hype. Rather than chasing trends or short-term performance, the framework is designed to harness the structural advantages of software platforms and translate them into sustainable long-term growth.